Alright everyone, XMAX Trading here. So I'm going to go over some interesting DD from the Nscc 010 that's going to come into play pretty soon, July 30th. I'm not too familiar with it, but I'm trying to learn more about it and give you guys the heads up. So go ahead and subscribe to the channel if you haven't already, and like this video, and let's get started. So here's a new regulatory coming out. Let's see, so NS 010. Proposed rule change. Collectively, okay, so to make central clearing available for Nscc for equity securities financing transactions, for broadly speaking, transactions where parties exchange equity securities against cash and simultaneously agree to exchange the same securities and cash, plus or minus a rate payment on a future date, collectively SFTs. Text of the proposed change. So let's go ahead and go to Twitter real quickly. So Maverick did some good DD on it. Nscc 010 looks spicy. Naked shorts are in here. Fire sale. Fed delivers liquidation of defaulter. So financial transactions. So securities financial transaction involves the owners of securities, typically a registered investment company, pension, wealth, sovereign fund, transferring those securities temporarily to a borrower, typically a hedge fund. SFTs are often facilitated intermediated by a broker-dealer. In return for the lent securities, the borrower transfers collateral, a net rate payment for typically transferred to either the lender or the borrower that reflects the liquidity of lent securities as well as interest on any cash collateral. So yeah, it looks like these pension plans and sovereign investment funds are lending out securities to hedge funds to borrow, probably for shorting. Nscc understands SFTs provide liquidity markets and facilitate the ability of a market participant to make delivery on short sales, thereby avoiding failures to deliver, naked shorts, and similar situations. An NSC affiliate processes and deliver orders related to securities lending transactions. Securities have a value of $150 billion. Another point that he points out: cash or securities is applicable, which should limit the propensity of market participants to seek to unwind their transaction in a stressed market scenario. Liquidity risk may arise in the context of a stressed market scenario. Borrowers or lenders concerned about the counterparty's creditworthiness, aka the hedge fund's creditworthiness, seek to unwind their securities lending transactions and obtain return of their cash collateral. This occurred to an extent in 2008. Began demanding return of borrowed securities in exchange for the cash collateral borrowers had posted to firm lenders. These runs, aka like a bank run, may require institutional firm lenders to quickly sell securities that are subject to their cash reinvestments to raise cash to return to the borrowers, thereby creating a potential fire sale condition. With respect to investment securities, described below, borrowers may need to purchase or reborrow securities in a stressed market condition, leading to potentially significant losses. Fire sale risk is described in the event Nscc would conduct a centralized, orderly liquidation of defaulters' security financial transaction positions. Such an organized liquidation would result in substantially less price depreciation and market disruption than multiple independent, non-defaulting parties racing against one another to liquidate their positions. In addition, Nscc would need to liquidate the defaulter's net position. Limiting the positions that need to be liquidated to the defaulter's net would reduce the volume of required sales activity, which in turn should limit the price and market impact to close out the defaulter's position. Nscc will also use risk management resources to provide confidence to market participants that they receive their cash or securities back as applicable, which should limit the propensity of market participants to seek to unwind their transactions in a stressed market scenario. By lowering the risk of liquidity drain, I don't know, it seems like they're trying to protect the hedge funds. Some people are noticing that it doesn't matter that DTC Nscc has not enforced any filings. A lot of people are suspicious of this. Let's see if we can go. Fire sale risk mitigation. Market distortion for fire sales. Of securities lending transactions, aka shorts. The primary risk of fire sales relates to the reinvestment of cash collateral by institutional firms that are lenders in securities lending transactions. Market liquidity. Overnight, SFTs. Nscc finds it therefore appropriate to make overnight term SFTs with scheduled date for final settlement date on the next business day rather than open transactions eligible for central clearing through prepare. I don't know, this seems sketchy. Shoot. Let's type in naked. SFTs involve the owner of securities. SFTs are often facility brokers and lenders. In addition to lent securities of our trans collateral, any security, make the ability for market participants to make delivery on short sales, thereby avoiding failure delivers and naked shorts in similar situations. Yeah, it's pretty complicated stuff, guys. I'm trying to think what key parameters. I don't know, maybe you guys can do more. You can find out more about this and now you make more sense of it because it's very, very dull stuff. Consistent with the cash market transaction, Nscc clear say where cash is used to satisfy members' obligations. Hmm. 369 pages of this. Okay. It is occasionally the case that the securities lending market that a borrower is solvent and able to satisfy the obligations as they become due, but unable to deliver the lent securities to the lender within the timeline requested. The contractual remedy that has been developed in the bylaw of securities lending market in these situations is a buy-in. On this remedy, the lender may purchase securities equivalent to the borrower's securities in the market and charge the borrower for the cost of this purchase. This serves to facilitate the lender because it allows the lender to recover securities, benefits the borrower to avoid situations of the borrower's failure to perform under a single transaction or even a default, and close out all securities. And potentially other positions through cross default. Similarly, a bilateral space, securities borrowers may accelerate settlement. Clearing service will retain buy-in. Failure. Corporations such as may designate delivery of foreign securities shall be in pursuit to arrange the meeting with individual parties, shall not govern any such delivery of failure to deliver securities. Qualified securities depository. Huh. A lot going on here. All right, guys, that's it now. Just want to check on some stuff. See you next time.